First section of my book I call the verdict of history. I went further back than any other researcher in investigating the historical returns on the major classes of financial assets, stocks, bonds, treasury bills. It took me almost 3 years to collect that data. Back almost 2 centuries of data, the longest that has ever been investigated. And after I collected this, I could answer the following question. How does your wealth grow over time in these major asset classes? What I'm going to show you here is a graph over the last 200 years, and this is a graph of your wealth growing after inflation. Let me show you first stocks. If you put a single dollar in the stock market in 1802, reinvested those dividends, let those capital gains ride, that single dollar would turn into over $600,000 by the middle of this year. If you did the same with government bonds, reinvesting the coupons, you'd get to about $1,000 after inflation. With treasury bills, just under $300. And the next one is interesting. I get a lot of questions about gold, and certainly gold has done pretty well over the last couple of years. But it's interesting. If you bought a single dollar's worth of gold in 1802, put that gold away in the vault, and then took it out today and sold it, after inflation, that gold would be worth $1.29. So over 2 centuries, you only gained 29 cents against the rate of inflation. And of course, our dollar has depreciated. It is only worth 6 cents of what it could buy at the beginning of the 19th century. But I think what's so important is that top line there, the stock line. Let me show you what a trend line is. That's a least squares regression I can put through there. Look at that, how unique that asset is. None of the other ones there has the trend line effect, the straight trend line, the clinging to the trend line. All the other asset classes tend to wander up and down. But this asset class has a uniqueness on its rate of return. And by the way, you see that peak right at the very top? That was in March of 2000. I'm going to talk about that later. We were 80% above the trend line. And when you're that far above the trend line, you are at risk. And we were at risk. Subsequently, in October 2002, we went 30% below the trend line. Now we're pretty close to the trend line. And when we're close to the trend line, that is good news. Because history tells us that's the most likely we're going to get near the historical returns on stocks. Now, what are those historical returns? That's given here on the next page. I talk about the average annual returns after inflation on a diversified portfolio of common stocks over many different time periods. And in my book, Stocks for the Long Run, there are probably thousands of numbers. The single most important number is the one I'm highlighting right now. From 1802 through June of this year, the average annual rate of return on a diversified portfolio of stocks, now this is dividends and capital gains, is 6.8% per year. Now 6.8% is a number that doubles, and I'm not just talking about dollars, doubles your purchasing power on average every 10 years. Isn't it remarkable? But on average, investors have doubled their purchasing power every decade over the last 2 centuries. All right? Look at how stable it is over major periods of time. 1802 to 1871, 7.0%. 1871, 1925, 6.6%. From 1926 to the present, which is often regarded as the more modern period of returns, 6.7%. Since the end of the Second World War, 6.8%. That is remarkable. That all these numbers are between 6.5% and 7% is what we economists call mean reversion of equity returns. Fancy name. All it means is that in the short run, we can be quite volatile. But in the long run, it moves towards that range. Let's talk a little bit about the valuation of the market. Is it crazy or not? I'm going to give you the price-earnings ratio on the S&P 500 or a like group of stocks. Now, we can't go back to 1802. We have earnings data back to 1871. And you can see, wow, that's a real volatile number, right? The average has been around 14 to 15. We're now around 17. And the bears always tell me that. They say, Jeremy, they say, you know, we have not had that washout that we need to have at the end of every bull market. We never got that PE down to single digits. You do see it has gone down to single digits. Now, I'm going to answer the question about whether we're going to go down there or not. But first, I want to talk a little bit about the record high that we experienced 1998 and 1999. Let me show you quarterly price-earnings ratios on the S&P 500, and then one segment of the S&P 500, the technology stocks. 78 of the 500 stocks, technology stocks. It's really fascinating. The price-earnings ratio of technology stocks, that's the yellow line, usually is 1 or 2, 3 points above the rest of the market. Yeah, you grow faster, I know that, but you know, you are a cyclical industry, capital goods industry. I'm not going to get that excited about you. By the way, the early 90s, interestingly enough, you know, it was below the rest of the market. That was, in fact, the only time in the 50-year history that we had PEs. And by the way, in my estimation of returns, that was the only time that technology was actually a buy relative to the rest of the market. But then you could see the big mountain that we climbed in 98 and 99 all the way into the 70s and even higher. Those 78 stocks, by the way, comprise almost 1/3 the market value of the entire S&P 500. You know, I was asked to comment on that, and you know, I had written the book Stocks for a Long Run. I was a bull on stocks. But once I saw those valuations get as high as they did, I said, hey guys, this is a time to get out. I wrote an article for the Wall Street Journal. I'll show you that right over here. Big cap tech stocks are a sucker's bet. Strong words. But I highlighted 9 big cap stocks. You can see them like Cisco, AOL, Oracle, Nortel, Sun Micro, EMC, JDS Uniphase, Qualcomm, and Yahoo. I said, even if their earnings growth is as fast as the optimists have projected, they are not worth the triple-digit price-earnings ratios that people were paying for those stocks. You know, I look back on history, there's never been a big cap stock that's worth triple-digit. I don't mean small caps, but big ones that are over 100 times earnings. In fact, if you go back in history, the closest one ever came was in 1972 when Polaroid sold at 95 times earnings. And I remind you that that was not a good investment back then. You know, you can see the date on this was actually March 14, 2000. The NASDAQ peaked on March 10th. You know, everyone came up to me and said, Jeremy, you're the guru of the market. You picked the top. And, of course, I lectured to my students, there are no gurus. I said, you know, short-run prediction is hazardous. It was lucky. I knew there was a bubble. I'm sure many of you knew it was a bubble. But we never knew when it was going to pop. Let me tell you one thing. Bubbles pop later than we expect. That's one thing that often happens. This one ran an awfully long time. You know, something else I said in that article. I said, you know what? Out of tech, you know, there's 10 sectors in the market. Get out of that tech sector. You're okay in the other 9. Let me show you something which is interesting. If you put $100 in the S&P 500 on December 31st, 1999, this is how your wealth would have accumulated over the next 3.5 years. Down and then back up. If you put them in those technology stocks, the 78 technology stocks, you've done a lot worse. If you put them into 422, just get out of one sector. This is how you would have done. Actually, not badly at all. In fact, you are well ahead of where you were in March of 2000. If you just lightened up on technology, say, you know, whatever I've had, I'm gaining, I'm not going to be a pig here, I'm going to move out, I'm just going to get out of that sector, you'll be way